Hello everyone and welcome back to the Dinar Daily, your most trusted source for in-depth analysis and level-headed reporting on currency developments. Today, we are embarking on a comprehensive journey that delves deep into a comparative study that our community has requested time and time again. We are looking at two currencies that often spark intense curiosity, rampant speculation, and significant global attention: the Iraqi dinar and the Vietnamese dong. When these two specific currencies are mentioned in the same conversation, we are instantly stepping into a complex narrative filled with rich history, economic uncertainty, massive rebuilding efforts, and long-term national aspirations. These are not just units of trade. They are economic symbols that have lived through powerful historical events, shaping not only their local environments, but also how the international financial community views them today. We are going to strip away the noise and look at the fundamental facts that drive these economies. By the time we reach the conclusion of this broadcast, you will have a clear understanding of why one of these currencies is viewed by market observers as a potential future comeback story, while the other is regarded as a slow, steady, and consistent climber. It is crucial to understand that the identity of a currency in the foreign exchange world is never created overnight. Rather, it is forged through decades of conflict, recovery, policy reform, and industrial growth. If you have been following the trajectory of the Iraqi dinar, this full comparison is designed to provide you with the kind of high-level insights that are rarely explained with such clarity and simplicity. We are going to explore the distinct paths these nations have taken, and what their economic foundations tell us about where they might be heading in the coming years. To truly understand the modern identity of the Iraqi dinar, we must first look back at the arduous journey it has taken, starting from the moment it replaced the Indian rupee during the era of British control. Every major event in Iraq's political history has left an indelible mark directly onto the currency's value and its international reputation. The timeline is critical here. When the Gulf War occurred, the economic landscape shifted drastically. Sanctions were tightened around the nation, and the economy began to struggle under enormous external pressure. Later, the conflict in the early 2000s created another massive turning point. New banknotes were introduced with the promise of a stronger future, featuring better security and hopes for stability. Yet the road to recovery proved to be steeper than many anticipated. Despite improvements in monetary policy and the modernization of physical money, the reality on the ground was that Iraq continued to face difficult times that significantly slowed down the path to financial strength. Political challenges, massive rebuilding efforts, and a heavy reliance on a single commodity have all shaped the behavior of the dinar. Investors and financial observers continue to watch this situation closely because the dinar carries something unique: a sense of what it could possibly become if the nation reaches a sustained period of peace, economic diversification, and structural reform. It is this what-if factor that keeps the conversation alive, distinguishing the dinar from many other currencies in the developing world that do not possess such a reservoir of untapped natural wealth. Now let us shift our focus to the Vietnamese dong to see how a different approach yields different results. Its history tells a completely different story, yet one that is equally filled with major historical turning points. The dong was first created when Vietnam fought for independence, and later became the unified national currency when North and South Vietnam joined together. In those earlier years, the economy struggled immensely with high inflation, low global trade, and a system that was heavily centered around strict state control. The value of the dong dropped significantly during those times, mirroring the struggles of a nation trying to find its economic footing after years of devastation. However, a major transformation began in the late 1980s when the government decided to radically open its economy to the world. These reforms, known as Doi Moi, did not bring about changes overnight, but they set a new course, Step by step, the economy became stronger, more open, and deeply connected to global markets. Over time, Vietnam developed a hard-earned reputation for stability and continuous growth. Today, the dong may still look low in numerical value when compared to Western currencies, but that number does not tell the full story of the nation's success. The country behind the currency has become a key global exporter, and that success has helped the dong maintain a more controlled and steady path compared to many other developing nation currencies. It is a story of integration, where the currency serves as a functional tool for a manufacturing powerhouse rather than a speculative asset. To understand why the dinar behaves the way it does today, we need to look at the bedrock of Iraq's current economic foundation. Here lies one of the biggest challenges the country faces. Oil is responsible for more than 90% of Iraq's government income. This creates a dangerous balance because when global oil prices are high, the economy has strength and liquidity behind it. But when oil prices fall, the entire financial system feels stress almost immediately. This extreme volatility makes it difficult for the central bank to maintain a long-term strategy without constant adjustments. The currency becomes tethered to the price of a barrel of crude, rather than the productivity of the Iraqi people or the output of its factories. Iraq possesses huge natural resources and tremendous potential, which is undeniable. However, developing new industries outside of the energy sector takes time, long-term planning, political stability, and large-scale investments. Until Iraq successfully diversifies into new areas such as agriculture, manufacturing, technology, or tourism, the dinar will continue to face specific economic pressures. Many analysts believe that Iraq has the opportunity to transform its financial system in the future, but progress must be steady and consistent. That is the key factor that could unlock the dinar's potential over years, not weeks or months. It is a waiting game that requires patience and a keen eye on government policy regarding industrial development. Vietnam's economic structure gives us a starkly different picture. Unlike Iraq, Vietnam does not depend on just one major export to keep its lights on. Instead, it has built a wide mix of industries which include technology production, electronic assembly, farming, fishing, textiles, tourism, and a growing service-based economy. This diversity is one of the main reasons Vietnam can handle global economic changes more smoothly than many of its peers. Even if one sector slows down, the others continue supporting jobs and financial growth. This creates a safety net for the currency, as the demand for the dong is driven by various sectors, smoothing out the peaks and valleys of global demand. Over recent decades, major international companies have opened massive factories in Vietnam because of the country's low labor costs, continuously improving infrastructure, and strong commitment to global trade. This flow of foreign direct investment has brought more money into the country, expanding the nation's ability to take part in global markets. The dong benefits from this consistency because the world sees Vietnam as a reliable partner that keeps moving upward. The more Vietnam develops its industries, the stronger the long-term support behind its currency becomes. It is a cycle of growth where investment leads to production. Production leads to exports, and exports lead to currency stability. When we look at how each currency is traded today, we see two very different environments. The Iraqi dinar, while a national currency with a strong historical identity, is not easily traded on the global forex market. It has very limited international circulation, and there are many stringent rules about how it can be bought or sold. Most of the time, trading the dinar happens through specialized channels rather than on the major global exchanges where dollars, euros, or yen are traded. This creates low liquidity and makes it difficult to measure the real market value at any given moment. The dinar's movements are strongly shaped by the specific decisions of the Central Bank of Iraq, and by ongoing political developments within the country. On the other hand, the Vietnamese dong is much more active in international exchange, especially because of the country's massive global trade involvement. Vietnam uses a managed float approach where the currency can move, but not freely or too quickly. The central bank watches the markets closely and steps in when needed to ensure stability for its exporters. This helps keep the dong from facing extreme drops or sudden shocking changes, which gives the world more confidence in its behavior. It is a system designed to facilitate business, ensuring that companies buying Vietnamese goods can predict their costs reasonably well, which in turn encourages more trade. Now, we move into an interesting area that defines much of the online conversation: investment speculation. The Iraqi dinar has developed a reputation that goes far beyond regular economics. Because of the major events Iraq has lived through and the rebuilding efforts that followed, many people around the world continue watching the dinar with the hope of a major future revaluation or significant strengthening. Some believe that once Iraq achieves long-term political calm and stronger developments, the dinar could rise dramatically. But even though the potential exists, the situation is incredibly complex. Iraq still faces political disagreements, rebuilding challenges, and large economic reforms that are still in progress. The dinar remains tied to those conditions, and the path forward must be long and steady if the currency is going to achieve global recognition. For now, the dinar sits in a place where potential meets uncertainty, attracting attention from people who believe major change could happen someday. Meanwhile, the Vietnamese dong does not attract the same type of high-risk speculation. Instead, people tend to see it as a currency supported by steady national growth. Vietnam has achieved slow but continuous improvement in wages, exports, and production capacity. The narrative around the dong is not about a lottery ticket-style win, but about the compounding interest of a nation that is getting to work every day. Because the Vietnamese economy is linked to global supply chains, the dong reacts to clear and common market forces rather than sudden disruptions. Inflation does show up occasionally as a concern, and Vietnam must constantly compete with other export-driven economies such as China and neighboring Southeast Asian nations. But the long-term story behind the dong has been about progress, structure, and stability. People looking at the dong generally expect more of the same: controlled growth and steady development. This predictability is arguably its greatest asset, making it boring to speculators but incredibly attractive to corporate treasurers and international businesses. Global perception plays a powerful role in shaping how currencies are viewed. And this is where we see one of the biggest differences between these two. When international investors look at Iraq, they see a nation working through political tensions, infrastructure challenges, and economic rebuilding. This leads to cautious attitudes from the outside world, where each decision by leadership can shift opinion quickly. A single change in government policy or a new challenge in the oil sector can influence market expectations almost instantly. The risk premium attached to the Iraqi economy is still high, which naturally suppresses the international demand for holding the currency for trade purposes. In contrast, Vietnam enjoys a reputation as an important global manufacturing center. The world views it as a place where products are made at high volume and exported everywhere. Supported by trade agreements, international partnerships, and growing confidence from global companies, the dong benefits from a stable and improving reputation. In the long run, the way the international community feels about a country can be just as important as financial numbers, because trust influences the demand for the currency itself. When major tech giants move production to Vietnam, they are essentially placing a vote of confidence in the future stability of the dong. Government strategy is another key part of this comparison. In Iraq, the central bank has the tough mission of managing a currency inside a developing system that still faces fast and sometimes unpredictable changes. Policies are heavily focused on keeping inflation down and maintaining a stable exchange rate against the US dollar. Foreign currency reserves become a shield to defend the dinar during hard times. A large amount of effort is directed towards stability and defense, rather than aggressive growth. It is a strategy born of necessity, aiming to protect the purchasing power of citizens in an economy that imports almost everything it consumes. Vietnam's government, however, uses a strategy designed to support trade competitiveness while protecting the dong from quick drops. Because Vietnam participates heavily in global exports, the central bank ensures the currency remains attractive to foreign buyers while also reacting to global changes to protect long-term progress. One country is defending stability amid uncertainty, while the other is balancing growth with security in a rising economy. Both strategies reflect their unique national realities. Vietnam can afford to be more dynamic because its economy is more diversified. Iraq must be more conservative because its economy is more fragile. When we compare the two currencies side by side, we notice that even though they share some similarities, those similarities are far overshadowed by huge differences. Both currencies come from developing nations that have lived through high inflation in the past. Both have been influenced by war and major national transformations. Both are managed closely by strong central bank policies, and both carry low numerical exchange values when compared to major global currencies such as the US dollar or the euro. However, looking past the zeros on the banknotes, the economic engines driving them are fundamentally different in design and function. After those shared features, the road splits significantly. Vietnam built its success on economic diversity, increasing exports, and strong international participation. Iraq still depends heavily on oil, a resource that can produce wealth but also fosters instability. Vietnam's story has been steady progress forward, while Iraq's story has been one of rebuilding after setbacks. The dong has earned global confidence from performance. The dinar continues to attract attention based on possibility. As we move further into the decade, it becomes clear how much the future of each currency depends on the structural changes happening inside their respective borders. For Iraq, there is a huge opportunity waiting in the wings. The nation has one of the largest supplies of oil in the world, and new development projects can help create jobs, build stronger industries, and expand international relationships. If Iraq reaches a period of stability and long-term reform, the dinar could benefit greatly. But that goal cannot be achieved overnight. It requires years of planning, consistent policy, and cooperation across the government. The dinar's best path forward comes from building trust with the world, proving that it can be a stable store of value independent of the fluctuating price of oil. Vietnam's dong will continue being shaped by economic production and growing involvement in world markets. The more Vietnam develops technology, services, and high-skilled labor, the better positioned the dong becomes for future competitiveness. Vietnam's story is already in motion, and its challenge is not to start a new chapter, but to continue the one it has already written successfully. The transition from low-cost manufacturing to high-tech production will be the next great test for the dong, determining if it can maintain its stability as the economy matures. Another area worth noting is public confidence. In Iraq, many citizens hope that a stronger economy will eventually lift the dinar and improve daily life. People inside the country watch the currency closely because its strength affects buying power, wages, and national pride. Belief in the currency can help support its stability. In Vietnam, confidence has grown because people see real improvement around them. New factories, busy ports, new airports, foreign businesses, and better job opportunities. This visible progress helps build trust in the dong. When people believe in their currency, they are more likely to save, invest, and support the national economy. As we reach the end of this complete side side-by-side analysis. Remember the most important point. A currency is much more than a number on an exchange board. It is a symbol of a country's strength, its struggles, and its ability to grow into something stronger. The Iraqi dinar carries the possibility of powerful future change if the nation continues to rise and diversify. The Vietnamese dong carries the proof that steady development can reshape the value of money over time. The next chapters for both currencies are still being written, and the world will be watching every step along the way. Thank you for tuning into this deep dive comparison here on the Dinar Daily. If you found this breakdown helpful, please like and subscribe to stay informed on all future updates. Stay curious, stay informed, and we will see you in the next report.